I just want to thank everybody for joining this webinar. It's basically an introduction to the Intra-Day Momentum Method. This is a mathematical model for determining intraday market direction for US equities and ETFs. Basically, in this webinar, I'm going to discuss the reasons why it was created, the books, videos, and learning materials that I studied in order to create it, examples of the research. I'm going to go over the track record for the last 5 years and talk about the statistical significance in terms of the range and the levels. I will also demonstrate mathematically that trend following is likely to give a trader an edge. I'll also talk about some higher probability things that I've discovered just within the last several months. I will also talk about fast moves, and is it possible to determine what a fast move is with the intraday momentum method levels. The reasons the intraday momentum method was created was because I had studied numerous traders who were published. A lot of them were traders such as Jesse Livermore, Jeff Cooper, Larry Connors, and Linda Raschke. I also studied the opening range breakout by Toby Cabell, as well as the logical trader by Mark Fisher. When I studied these, a couple of things that I noticed was that I felt like Jesse Livermore actually didn't look at charts, but he looked more at data. And I think that most traders actually want to be a lot more like Jesse Livermore, understanding that his biggest drawback was actually the fact that he didn't manage risk effectively, and possibly not at all in some instances. During studying the logical trader and the opening range breakout by Toby Cabell, I always thought that a distance in price was most likely more important than a time period over X number of minutes. So basically, I decided that what if I could actually determine which direction the market would likely close on from the open, then that would also most likely give me some ability to determine if a trend actually would increase a trader's chance of success. And also the largest move of the day, if the market was to close on the upside from the open or the downside, we could actually determine that if we could figure out that, then we could enter trades in the direction of the biggest move of the day. I found that traditional technical analysis techniques did not allow a trader to determine outcomes effectively. This was basically because in 2004, I was working as a proprietary trader, and I sat and was listening to traders talk about technical analysis as well as fundamental analysis as to why they wanted to trade a particular stock on a given day. I sat down and I said, is what they think is happening what's really happening? And over the course of the next several days, in particular with moving averages, what I found was that moving average wasn't calculated until the end of the day. And therefore, when people thought that moving average was actually tested, the moving average was probably somewhere else. Like a market would move down, look like it tested moving average, and at the end of the day, it comes through the bar, when in actuality, it would be somewhere else. So I decided that it wasn't really an effective real-time tool. Sure, it's definitely useful on a longer term time frame, but it can't be calculated until the end of the time period in which it's being calculated on. I thought that a mathematical approach would give a trader the ability to define patterns and determine if the patterns were historically significant. And most importantly, it would allow a trader to attempt to define risk before entering a trade. In 2013, May 14th of 2013, I was published at TradingMarkets.com in an article that says, "Determining Daily Intraday Direction, Is It Possible?" This was what I was thinking when I created the algorithm that determines market direction. Then later, 1 week later, actually a little bit later, published an article, "How the Intraday Momentum Method Can Help You Make Better Trading Decisions." At the time, I didn't have a way to demonstrate the model in real time. It took me a couple of years to figure out a way that could actually be done. I had to develop my own APIs, as well as look for sources where I could get the data and translate it into an application that could be viewed. I also decided to apply the model across a large number of stocks, and I chose the S&P 500, or over 400 stocks in the S&P 500, simply because I thought that if I was doing something mathematical, it made no sense to not apply it to a large number of stocks. It's not, I wasn't going to look at one particular market. I just wanted to see how effective it was over a large number of stocks. This scientific approach to trading was developed because I saw the needs and pains of traders years ago. The needs and pains that I recognized by studying numerous published traders were: the trader needed the ability to explain why a trader made money. Was it intuition, luck, skill, a pattern-based strategy, reversion to the mean, trend following, risk management, or possibly any or all of the above? A trader needed the ability to define patterns mathematically. The trader needed the ability to calculate risk and base that risk on the probability of a successful trade. Two questions that I wanted to get an answer to that I found no way of getting an answer to using traditional technical analysis were: does trend following give a trader an edge, and do fast moves come from false moves? I'm just going to go through some examples. These examples actually present themselves every single solitary day in the market. Basically, like I said, I apply this over 400 stocks. This is basically a fast move up, and fast moves are potentially the most dangerous moves for trading in the direction of a trend, I have found. This applied materials basically met a second level up within the first 30 minutes of trading. It then later became an intraday reversal by the end of the day. An intraday reversal is when a stock meets a level on each side of the open. As you can see here, Amazon actually reached the MS1 level down around noon, and then it proceeded to the second level down right around 2 p.m. And then basically it closed below the MS1 level down and above the MS2 level down. Here, JP Morgan reaches the ML1 level up, and it basically around noon, it continues higher for the rest of the day and actually closes above the ML1 level, ML3 level up. These are just examples of things that happen every single day. Over the last 5 years, I kept track of, like I said, I had to develop a web-based application because I didn't see, it wasn't feasible for me to go through 500 charts, draw a line on the chart, and determine where the market closed in relation to the levels. So I developed a web-based application, kept track of it every single day. Since I do have 2 days that are missing, and that was October the 17th, 2017, I believe, and 9/4/2019. But these are the statistics for the levels. Basically, this shows you that if a stock reached the ML1 level up, it closed at or above that level 50% of the time. If it reached the ML1 level up, it closed above the open 81% of the time. If the stock reached the MS1 level down, it closed at or below the MS1 level 47% of the time. If it reached the MS1 level down, it closed at or below the open 79% of the time. The percentage of reversals overall was 14%. Reversals typically, that is when a stock reaches the ML1 and the MS1 in the same trade day, they typically occur at overbought and oversold conditions. When the market gaps open with large gaps, volatility, in other words, is actually what increases the chance of an intraday reversal. This graph just shows you the different levels, the ML1 level, the MS1 level. As you can see, if we can filter out the intraday reversals, we get a higher probability of success from at or above that level. So it goes from 50% on the ML1 to 57% of the time if it was not an intraday reversal. On the downside, if a stock was not an intraday reversal, instead of 47% of the time, it closed at or below that level 54% of the time. This is basically a what could be seen in real time. This is not how it is actually set up because I don't show the actual prices. This is just a demonstration of what I use to track the data on a daily basis. As you can see, if a stock reaches a level, that level turns the color of the level. So an ML1 is reached, it turns green. If it reaches the ML2 or ML3 level, they actually turn green as well. So any level that has been met is turned the color of the direction. If a stock is an intraday reversal, it actually turns orange. So basically, if the stock reaches the ML1 and the MS1, it turns orange. The ML1 is a calculation. The momentum, basically, this is called the Intra-Day Momentum Method. And the ML1 is a price calculation from the open that historically a stock has closed above, at or above 50% of the time over the last 5 years. And that's applied to over 400 stocks in the S&P 500. The MS1 is the same distance from the open down, and a stock had closed below that 47% of the time or greater. So it's basically just a calculation in price that historically a stock had met. If it met that level, it closed at or above that level on the ML1 50% of the time. If it met it to the downside, it closed at or below that level 47% of the time. And if it didn't reach both the ML1 and the MS1, then it was increased to 57% on the upside and 54% on the downside. I basically chose to extend the levels out and by 3 up and 3 down, and this was really to determine a couple of things. First of all, I wanted to see if we got to one level, what percentage of the time did we get to the next level, and could we increase the chance that we would get to that next level. Basically, as you can see here, this is, I took the range of the day and divided it by the calculation that was used to determine the ML1 level up or the MS1 level. It doesn't matter, they're both the same calculation. And I came up with the fact that only 9% of the data collected over the last 5 years would have needed a fourth level. And this is based on a calculation of the entire range and not just the open. So basically, when you look at the open, the ML1 from high to the open, only 4% of the stock, 4% of the data would have needed an additional level to capture the entire day's trading activity. Same thing with the downside, it was a little bit higher. I think most people actually know that the market does have a tendency to move. The distance down is a little bit more than the distance up. And in particular, 6% of the time, we would have needed a fourth level when I divide the range of the open to the low, divided by the calculation needed to determine the MS1 level down. I took these out just a little bit more just to determine, what overall, what the bigger picture actually looked like. But the most important thing was I wanted to know, was I actually able to capture a large amount of a stock's trading range? That way, to some degree, you could say this is, I've been able to normalize intraday market activity to some degree. It wasn't something that I set out to do originally. The main goal was actually to determine if trend following actually gave a trader an edge. That was actually the main reason why these levels were extended out. So I had a question, and I think that most people actually who trade probably do want to know, does trend following give a trader an edge, and is it possible to mathematically define the ability or inability to give a trader an edge? So the probability of a close at or above the ML1, what I just decided to do was I took the data. I said, what if we get a high of the day that's just 1 cent higher than the ML1, and we get a low of the day that is 1 cent lower than the MS1? Does that increase the chance that we get a close at or above that level? And as you can see here, it was 0.6% of the time. And this is not taking into effect anything other than I didn't define a trend on any chart. Basically, all I wanted to do was know that if we get a high above this level by 1 cent, does that increase the chance that we get a close above that level? And as you can see, it's 0.6% of the time. So we go from 49.5 to 50.1% of the time, we get to close at or above the ML1 level. This basically also, when you look at the 47% and 50%, this also demonstrates that it is very likely, that alone demonstrates that trend following will get a trader an edge, because we have been in an uptrend for the most part for the last 5 years. So what percentage of the time, if we got to the ML1 level, did we get to the ML2 level? Or what time did we get to the next level if the level was met? I wanted to see, if I could actually increase these probabilities by any type of calculation that I could make. And what I found was, so if we get to the ML2, if we get to ML1 37% of the time, we get to the ML2. If we get to the ML1 and it's not an intraday reversal, we get to the ML2 43% of the time. If we got to the MS1 level, we got to the MS2 level down 38% of the time. And if we got to the MS2 level and the MS1 level, and it was not an intraday reversal, we got to the MS2 44% of the time. I took the calculation that I used to determine the ML1, and I multiplied that times 1.33 and added it to the open. And basically, this is just creating a new level above the ML1 to determine if we actually got to this level, would it increase our chance of getting to the next level? As you can see, if we get to the ML1 level, this new level, then 51% of the time we got to the ML2 level. And if we got to this new level down, we got to the MS2 level 52% of the time. So increased a couple of percentage points just due to the fact that it was not an intraday reversal. So basically this, to some degree, actually demonstrates mathematically that trend following would likely give a trader an edge. Over the last several months, actually, just within the last year for sure, I actually created a new level, and that level was halfway between the distance of the levels, the original levels, and the open. And what I wanted to determine was basically if we didn't get to this level, what percentage of the time did we get a close at or above the ML1? And what I found was that as long as the level down was not reached, which is halfway between the open and the MS1, then we got a close at or above the ML1 level 57% of the time. Now this totally eliminates the intraday reversal because the intraday reversal would have to meet that level and the MS1. So basically all I did was I took out, I basically said as long as this level was not reached, what percentage of the time did we get to the ML1? And that was 57% of the time, and it was approximately 50% of the time that we actually reached the ML2 level up. This is actually some stuff that I've actually been working on just over the last few months to try to increase the probabilities of the trades. I actually published some stuff on LinkedIn, and typically those trades or those levels that I publish are of the high probability scenario, but I apply it to ETFs. And my ETF research is not as extensive over the 400 stocks in the S&P 500, and simply because I've got the data. I've just got to, and it is organized. It's just not put into the same format where I calculate all this stuff. And I've been working on that for quite some time. It's 5 years of data that I have to transfer from web-based applications into spreadsheets. So that being said, now we look at, well, as long as this level was reached, what percentage of the time did we close at or above the ML1 level? And it actually was decreased. It's actually about 53% of the time, if the level down was reached, you would close above the ML1. So basically, we found out that if you get this move that is rather significant to the other side of the open, it's not likely that you get a close above the ML1, and the chance of reaching the ML2 was greatly reduced. So basically, this to some degree says that if you get to this level down, you're probably not going to want to trade in the direction of the trend if the ML1 level's up, because there's not the chance is actually less than 50% that it would close at or above that level. And this is over the stocks. This is not the ETFs. The ETF, like I said, the ETF stuff is actually quite new. I only started posting to LinkedIn these levels because what I wanted to do was demonstrate it. Like I said, I do this on over 400 stocks every single day, but what I wanted to do was get it in something that, in a form that people could read and understand. And if I could get their attention with this type of stuff, then they would say, well, because it's not possible for a person to look at more than probably even 10 or 20 stocks at the most at any given time. Can we define a fast move, and do fast moves come from false moves? This is one of the questions that I know that a lot of the traders that I studied talked about. Fast moves possibly come from false moves. I would say that they're probably the most dangerous of moves. News-driven moves, however, are just something completely different. And typically a news move can take a stock much further than the data that I've actually gone through. This was actually the QQQs. It met the MS1 level down in the first 15 minutes of trading. What I found is that stocks that do make fast moves will not, if it's going to be a trend day, it's not likely to pull back to the open or much higher than the open. One of the things that I try to stress in the research that I publish is that if it is a fast move, a good entry point, if you believe it's going to be a directional move that day, would be halfway between the open and the level, such as the MS1. Basically, this was a day where the market basically went down pretty much all day. The QQQ, I believe at the end of the day, it had reached an MS 5, I believe, and it closed below a 4. The next, this would have been one of those days where it was pretty much down. I believe it was September 3rd that this actually happened. The next day, we got an MS3 level down again. I basically published something on my Facebook profile and some other things that back-to-back MS3 level closes are not likely. I've done some of this research and determined that I think about if you got to the MS3 level down, it's not likely 2 days in a row to get closes below that level. Obviously, things happen. News events might cause something like that, but typically that's not the case. This is another fast move, and the DIA came on the 21st. Basically, we got to move to the ML1 level up. The market then pulled back, and basically it was pretty much range bound that day. But as you can see, the further it goes away from the ML1 level, the less likely that it will close at or above that level. The DIA actually came within 3 cents of the downside limit. That downside limit is basically halfway the distance from the MS1 to the open divided by 2. So basically it's just the calculation divided in half. The SPY, this was on the same day, reached the ML1 level up in the first 30 minutes of trading. Basically came down, touched the downside limit, rallied back up to the ML1, and then closed below the open. This is just a demonstration of what is shown in real time, such as the fact that these current positions on this page show you what levels were met. Basically, the SPY, this is actually real time. Basically, the SPY has reached the MS2 level down in today's trading. And this is not the high probability trade because it actually had reached the distance halfway between the open and the ML1 before it reached the MS1 level down. and the MS1 level down was 354.01. And it actually reached the MS2 level down. This stuff can be reached at QATsystems.com /analytics. Basically, the high probability ETFs. These are the ETFs that have not reached the level halfway between the open and the ML1 on the downside or the MS1 on the upside. So any of these stocks that are listed here have not reached the level that I actually call upper limit or downside limit. I also have over 400 stocks in the S&P 500 that are tracked in this page. So basically, this is the exact same thing as stuff that is tracked in the ETFs. It keeps track of where a stock is. Now these are the HP, and you won't see any intraday reversals on this page because they only, as long as they haven't reached the level on the opposite side of the open, they will be shown here. Any stock that has reached that level is more likely to become an intraday reversal. So this page actually shows all of the stocks that are tracked in the S&P 500. Like I said, there's over 400 of them, and if they are a reversal, it shows that they're a reversal today. So they won't. The only stocks that do show up on the HP or ETFs are the ones that have not reached the level halfway between the open and the ML1, or halfway between the open and the MS1. What we have, basically, I'm giving it free trials for 7 days to the Intra-Day Momentum Method for the S&P 500. Basically, these are stocks that meet the levels. This is not the high probability scenario. This is just if a stock reaches the ML1, it closes at or above that level 50% of the time. If it is not an intraday reversal, it closed at or above that level 57% of the time. The higher probability scenarios, actually, the probability is greater than 50% of the time if it reaches the ML1, and approximately 50% of the time it reaches the ML2. I have also a web-based application for the ETFs and the ETFs high probability. You can subscribe to the Intra-Day Momentum Method at QATsystems.com /register, analytics/register. And you can get basically all of this information I will give you for 1 week. It's the Intra-Day Momentum Method. You get the intraday method for the S&P 500 as well as the ETFs. You can select the ETFs alone, or you can just get the S&P 500. If you have any questions or would like more information on my research, you can contact me at toddhudson.qatsystems.com. It's todd.hudson@qatsystems.com. Thank you very much.